July's US employment report unnerved global markets. Growth in non-farm payroll slowed to less than half the average of the prior 12 months, and the unemployment rate rose by 0.2 percentage points to 4.3%. The unemployment rate rise holds particular significance for many in the market, as it triggered the SARM rule, an often discussed indicator of recession, and also because the July print was 0.1 percentage points above the peak rate the FOMC foresaw through 24 to 26 at the time of their June meeting. Fearing the FOMC may have missed their opportunity to produce a soft landing, participants quickly jumped to price in a near 100% chance of a 50 basis point cut in September and a 60% chance of follow-up 50 basis point move in November. Around 110 basis points of easing is currently expected by end 2024, to be followed by another string of cuts in 2025, towards the FOMC's 2.8% longer-run neutral estimate. Westpac has warned throughout 2024 of a coming deterioration in the US labour market, so July's outcomes are not a surprise. That said, we remain confident in the underlying health of the US economy and believe the FOMC will too, resulting in a more muted easing cycle than the market currently expects. Engaging the underlying health of the US economy, first it is important to recognise that US employment estimates are, at worst, pointing to a stalling of job growth, not an outright contraction. Household employment, the weaker of the two key measures, has averaged a 19,000 gain per month the past half year. While the ISM surveys have in 2024 signalled the possibility of a dramatic reduction in labour demand, the NFIB Small Business Survey's employment measure remains modestly above average, and the Federal Reserve's Beige Book in keeping with the household survey signal of only a stalling of employment growth. Hours worked also continue to track non-farm payrolls, so there is no evidence of hours being reduced disproportionately either. Meanwhile, current momentum in US economic activity is healthy, with domestic final demand growth near the long-run average through the first half of 2024. Households' decision to lock in historically low rates before and during the pandemic continues to provide benefit, while consumer wealth and debt levels remain constructive for spending and confidence. For the FOMC then, as inflation continues to come down and with the labour market now weaker than expected over the forecast period, there is reason to cut decisively into year-end and through early 2025. But, given the economy's resilience and the absence of evidence that inflation will soon undershoot their target, there is no need to rush to neutral or below. As before, we look for the FOMC to begin their cutting cycle in September with a 25 basis point cut. However, we now also forecast 25 basis point cuts at the November and January meetings, in addition to those we already expected in December and March. A cut per quarter from the June quarter will see our unrevised terminal rate of 3.375 reached at the end of 2025 instead of mid-2026. While we expect the 10-year to hold near its current level over the remainder of the year as rate cuts commence, it is then anticipated to drift back up to around 4% in mid-2025, putting in place a sizable spread to the Fed funds rate. This will be justified by the US economy's underlying health, but also the entrenched and growing federal deficit and evidence of inflation pressures related to capacity constraints and trade policy. For these risks to dissipate, investment at scale must be seen across the economy, requiring time and a substantial capital investment. To weather higher for longer interest rates, it is important the US consumer remain in strong financial health and positive on the outlook. Hence the need for decisive but confident action by the FOMC. We'll see you next time.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published, or reproduced in whole or in part without the prior written permission of Westpac.